Okay, so for kickoff, so I think I know, I'm looking through the list of names. I think I know nearly every one of you, but I'm Trent Lund. I'm your CEO for Wrkr, and to my side is Karen Gilmour, our CFO.
Good morning.
Yeah, so look, really excited to run through a presentation with you. There are some new joiners and new shareholders, so I will pick up a little bit of introduction around the business for clarity at the very beginning, and then we'll just jump into to the performance, the financial performance, and then the direction of travel where we see the business going to. And I'll try, as always, to leave as much time as we can for Q&A at the back end. So without further ado, welcome to Wrkr's investor presentation to cover our Q4 of FY2024, our last quarter for the financial year of our 4C and our quarterly update and forward looking. All right, so if I jump through, I'll leave the stats for all of you to look up. Our office hasn't changed, nor of our directors. Just some quick facts so everybody's in the same picture on Wrkr. So who are we? Our product mix is really about onboarding employees to employers, pay and super processing for both employers, payroll companies, and most significantly on behalf of super funds. And as well, we do the compliance reporting and lodgements and other license and credential checks for employees. Our revenue mix is predominantly SaaS user license. We run at about 5.2 million ARR, so a little over 50% of our business at this point, and that is obviously our main focus. We're built up of transaction fees, small amount of float income, and licensing fees, support maintenance. There is some service and consulting as we build and onboard new super funds in particular. Where we sit right now, tracking finishing the year out between our forecast of 9 to 10 million in revenue at the 5.2 mil ARR and around 9.2 million of operating expense. We sit at the moment, we touch a fairly large number of Australians, about 2.9 million users in total licenses. But in terms of our core business, which is our prime focus, and all new business is constructed this way, is around our SaaS users, so software as a service. We have 500,000, so 500,000 direct customers right now, trading at about an ARPU, so average revenue per user for the year of around $8. Of that base, that's predominantly built up of super contribution management, pay processing, and then some onboarding, which is an area we expect to grow as we move into the future. So just for everyone on the same page, what's the problem that Wrkr really solves? Well, there's two very large areas where the employer compliance obligations are incredibly complex. We see those, they're not just complex, they actually lead to fines from the regulators and also credibility for those employers. They sit around some actions within the hiring and actions within the paying of an employee, and that is our sweet spot as a business. So identification, checking that you're hiring people with correct work rights, correct visas to work in Australia, tax file number checks, and making sure those tax file numbers are accurately assessed, not just a form fill, tax declaration, super choice, which is quite complex. That includes stapling moment, includes offering choice to employees and providing default fund choices, bank details, and as I mentioned earlier, licenses and credentials. These are areas which quite complex to be a provider of these services, but highly iterative. As we build each service, we're actually building the compliance and the capability to add services more efficiently. So bringing employees in correctly is critical, and it's actually a fairly important precursor to paying employees correctly. Where Wrkr specialises today is the pay processing, wages, disbursement processing, so small fees, whether it be union fees or other disbursements for employees, super contribution payments, super contribution messages, single touch payroll report and lodgement, and then payment reconciliation for employers behind the scenes, as well as error reporting and correction. That is the sweet spot of Wrkr. We sit behind the scenes in many aspects of this business, but very key touch points around obligations. And at the bottom of the slide, just to point out, really the moat around our business is the heavy legislation and compliance required to participate in this space. Obviously, handling of PII data with consumer data rights consents, ISO standards, SOC 2, and all of the various protocols around cyber, as well as being a GNGB clearinghouse and gateway in the super, which there are currently only 9 of in Australia, an AFSL holder for non-cash payments, and also a digital service provider, tier 1 level to the ATO, which allows us to interact around tax and tax information. So that the core problem is the complexity in this space is actually far higher than most realise, and payrolls, super funds and employers outsource these steps really to companies such as Wrkr, but specifically Wrkr, to solve this level breadth and depth of challenge. That's really Wrkr. We remove that complexity and make it very simple. We take it a step further and we allow the employee to participate in the process of compliance. They own the data, they have the best information. We provide a mobile capability that allows the individual to provide all of that rich information, and a simple rule of thumb, literally, is they should be able to do it with their thumb while sitting on a bus. So scan your driver's license, we gather the information, we confirm it with a third party, we bring that information back, and I don't need to ask you for that information again, your date of birth, your name, middle name, your correct license identification. We then build upon that and continue to attest and validate that information behind the scenes, provide clean data into organisation systems. Obviously, providing that really builds the position for Wrkr to provide it as a one-stop shop for employers. It's a highly fragmented market today. There are many providers that do either just visa checks or reference checks or license police checks. There are few, actually none, that we've identified that provide the full breadth of these moments, particularly adding super and all the super contributions processing to that same stack. So positions us to provide a one-stop shop where employers can simply add the functions they need for their businesses. We've taken that in our business, and this is really the key growth, is working with MUFG, formerly Link, for those of you who've followed our various notices, and have a co-funded build, so significant funding from MUFG and also significant funding from ourselves to build an industry-based solution. So that is a solution that is a white label of Wrkr's one-stop shop to provide to super funds. So super funds can provide what is possible for them under the SIS Act, which is super contributions processing and the onboarding of new members, and that stapling moment for employers. So brandable for each super fund that are MUFG's clients, allows them to innovate on top of this platform, deliver it differently, but it is the same core underpinning platform of Gateway, which obviously gives great reach to the market for us over time, but also great cost control with one singular platform servicing multiple brands. I just touch on that because people seem to ask me a fair bit. We've invested for a long time with MUFG, and the length of time is really testament to the level of integration that has been built, the tightness between our core offerings. And I just want to sort of touch on that in two ways. One, if we think about just the super portion of the Australian market, where the bulk of our incomes are driven, there's around about 14.5 million employees, or about 19 million jobs. A lot of people work extra jobs. roughly 16 million is the top out number. It's a little lower than that, but they are the total members who contribute into their super funds over a year. MUFG currently serves the largest of those players in the industry fund groupings. And just to point that out, we're talking about Australian Super, who have about roughly, and these numbers are estimates because they fluctuate every quarter, but roughly 2.4 million contributing members. So that's members who aren't in the retirement phase. That's members who are processing super into their fund, creating contributions, which creates fees for Wrkr. So Aussie Super 2.4, Rest about 1.4, Host about 1.4, Cbus Hester about 1 mil each, and then a range of other smaller funds, around about 7 to 8 smaller funds that add up to around about 600,000 users. So net, MUFG and supporting them and making the investment we've done in bringing this to market so it's brandable and deliverable by each of the industry super funds positions us to chase around about that 7 million contributing members. It's not locked. We have to still convince and take them through the process, but feedback today has been exceptional. We're obviously very bullish about the opportunity that sits in front of us, and feel that there's plenty of reason for us to be confident that we'll succeed on the largest portion of that side. Specifically, why do we feel so confident? Well, one, all of those MUFG clients share a similar DNA. A large volume of employees that transact quite frequently, fast pay rates, but low FUM because many of them are industry first-time job workers, in fact, and therefore it's a price-sensitive market of which Wrkr is very competitive. So high volume, competitive on pricing, but most importantly, all of these funds share the same infrastructure, support processes, support tooling, and the Aspire platform owned and delivered by MUFG. We've integrated directly to that Aspire platform, and that's really the cornerstone of this industry solution. So I want to share that with you all because I get a lot of questions and just wanted to push through. Obviously, up in the top of the yellow box are also organisations who go directly to market, and that is why we've made the investment we have today with Workday and KPMG, but no doubt I've already read some of the questions, but there is a lot more to come in that space, which I'll wait till the Q&A. So that's just background of the business and where we've been active. I want to hand to Karen to run you through the financials, and then we'll get into Q&A.
Thanks, Trent.
Karen.
Lovely, and good morning, everyone. I'm going to jump right in and just let you know we've commenced the audit. So the figures I'm talking to today are the unaudited, and I'll focus more around our cash position on the back of the Appendix 4C and quarterly report. So it was a really fantastic result into the end of the year with a first-time positive operating cash flows in the history of the listed entity. So that was just a really good result, and it's showing our commitment to our driving those cost efficiencies, building a scalable platform, capitalizing on that investment we've made in the platform in terms of the containerization, the scalability, the multi-cloud and multi-jurisdictional capabilities, which are obviously now well and truly into play with the MUFG and the REST implementation for pilot. So we've seen the growth in revenues coming from that work. There has been a lot of investment to date to go into that from Wrkr, but we're starting to see the fruits of that work and the revenues coming through. We've had continual success in the SMSF hub, expecting around an $800,000 revenues from that product stream this year, up from $615K last year, and with a lifespan of about 2.5 years now. So that's been an excellent product under the banner. We've had stabilised revenues across our existing kind of Click Super Clearinghouse, disbursement and STP business. So that's good, and interest rates have stuck around. So we've seen that continual consistent float income as well. So our cash receipts from customers over the year is up 46% from last year. So that's really showing that kind of year-on-year growth that we've experienced, kind of over 40% in our revenue growth, achieving that again this year. And the cost to income ratio has come down, so down 36% from the prior year. It's really just showing that, that tight cost control, making sure that we're investing for growth at the same time that we're managing that working capital as closely as we can, and capitalize on those opportunities ahead of us that we can see in the pipeline. So onto the next slide, you can see this is just a good visual representation of the revenue growth and over the history of the company. Coming from the InPay Tech days, there was the merger with ComplyPath in 2021. We saw a jump in the revenues on the back of that technology and the licenses we have with our platform services there. And then we've continued to grow under that, the Wrkr brand after rebranding. That it's great to see that, and our FY24 projection is between that $9 to $10 million. And yeah, so we're looking forward to a good result for the FY24 year. So our financial outlook, as I just said, we're looking forward to a good FY24, very, very tremendous result with those positive operating cash flows for FY24. FY25, we're focusing on balancing the resource requirement we think we'll need for the pipeline that we can see ahead. I think after the REST implementation, we'll really see a kind of push from other funds. We hope to see a push from other funds for a speed to market and to be implemented onto the Wrkr platform through that MUFG relationship and partnership. So we're looking at how that will play out, what the resources are that we're going to need. It's quite heavy resource requirements as you develop and implement with such large funds, as you've seen with REST and what we've spoken about in the past. REST will come into pilot, it will move into transaction phase, and then hopefully we'll be working concurrently with other funds through an implementation phase. So that's a big year ahead of us for FY25. So we're all working together to plan that out at the moment and to see how best we resource and fund that, and to balance our investment between that, that short-term revenue generation and the long-term growth, which has always been our focus. We know that there's going to be some great market indicators that are going to drive the change in the market towards wanting to utilize better platforms like Wrkr, because you've got payday super reforms coming down the pipeline. And we can probably skip to the next slide there, Trent, which looks at those industry trends. So yeah, the big regulatory tailwind, which is, we look at things that are within our control, which are the left side, and the things that are kind of out of our control but working for us is those payday super reforms. So we'll see, at a minimum double the transaction volumes going through once those reforms come into play from 1st of July 2026. And so there's not a lot of time between now and then for funds, employers, payrolls to get their systems working as efficiently as possible to reduce the errors in data validation, to improve the user experience, and to make sure that they're fit for purpose when transactions double, if not triple, once we get to that phase. And Wrkr's platform has really been built around being ready for payday super. So all of those validations Trent was talking about earlier, as an employee comes in to the system, reduces those errors at the end, making the user interface easier, uploading superannuation contribution files that check it before it goes off, so you have reduced the amount of funds that come back or the error reporting from funds. So we think we're really well positioned in the market to take advantage of those payday super reforms coming. Also, interest rates are remaining. They don't seem to be going down too significantly anytime soon. So we'll continue to see that float income, which is really just something that we either kind of return back to investment, further investment into the platform and into the industry fund solution. Population growth is high. Immigration remains high, so we're seeing, you know, the transactions building from there. On the left side is the things that are within our control. And so that's what I've mentioned before about the tight control on our kind of financial management, and we'll continue to do that. And we're getting excellent feedback around our technology from industry bodies, our customers, and you know, funds. So it's great to hear that, and we're hoping that you're hearing that in the marketplace too. So yeah, on that, I might pass it back to Trent for final comments before we do questions.
Right. I'm sure this will come up in questions, but one of the things just to we sort of look at these regulatory tailwinds, and it's easy to say these are exciting, but actually there's less than 24 months before those regulatory changes come in. If you're a super fund today, or a large payroll provider, or even an employer with a large employee base, if you are processing quarterly today, and your staff, particularly in the industries we target, are typically paid fortnightly, you are moving from having a quarter, 3 months to resolve any errors. So incorrect payment of super, negotiate back with the super funds, have funds returned, etc. You're moving to 2 weeks. Now, that means either the same error continues to process again and again and again. So after you remediate once, you're back sending the same letters again and again and again, and processing. The reconciliation becomes far more complex. What that really means is you need more staff. And headcount is expensive. Training headcount is expensive, and it brings a large systemic cost to the market. So although we see the contributions for us, we will make far more income because there are more contributions to process. This is really where the value of our technology comes to play, because we lower the cost to serve, because we do a lot of real-time reconciliation, error reporting, and error removal, both from better data coming in, but also the way we've engineered our core platform. We are a software company, not a labour-based or services company. So having been designed that way, actually, we're quite favoured in the conversations we're having with the super funds. But that 24 months will put a lot of pressure in the system, because you need 12 months to educate and change and drive out new screens, new systems, new processes to educate your customers. That really leaves 12 months to decide on provider, implement with brand, take branding considerations, make any configurations that are unique to your business model, test the deployment, and then roll out. 12 months is actually not a long time in the super industry for that type of technology project. So we're certainly seeing it shift from educating the market to the market are now well and truly educated, and we're seeing great action. So when we talk about these tailwinds, they're very, very positive for our business. So I'm going to jump off and jump to questions. I'll just stop sharing so I can see your questions, and if that's okay. And we've got quite a few. So if I start at the top. API expansion to other HRM systems. Any in particular you wish to call out? Mark, I'd love to call them out. We're in NDA and in design with actually a couple right now that are quite significant. Workday, obviously, we're the most progressed, working with KPMG with Workday, but there are other larger players that are international that have been here a little longer, who have a need right now, and we're fairly well progressed. I kind of expect we want to be in a position to talk about those and put the names out. We just want to make sure that our solution's been tested, validated. But our move very much, you can expect to see over the next 12 months, us in the app stores for some of those larger players, and you know, their install base is big. Workday's is certainly large and growing, but the others are big. So we took the blueprint we've done with Workday, have really shrink wrapped that and perfected it, and we're now actively in and working with and testing it with some of the larger providers. Sorry, I couldn't give you more than that. John, interested in how you achieve a 25% price increase with Art. Was it new functionality or just underpriced? Thanks, John. Well, look, actually, you know, the wonders of CPI. When there's a renegotiation, CPI comes into play, and compounding CPI. But I think somebody once said there's nothing more majestical than compounding interest. It's a bit similar for CPI on charges, but in reality, there was a view that there is a substantive quality that Wrkr provide, and you know, there's certainly, we think that we don't provide that model to the market anymore, which is a pure license of our platform. We're not convinced that that serves for the best total cost of ownership or necessarily the security and controls that are plausible when you're in one SaaS environment. But so we don't do that model anymore, but it is testament to a very strong reputation inside Art and very strong delivery quality from the team, and that's really what helped underpin it. So they were comfortable in moving to that increase. So great for us because they're a large anchor client. Interested in a comment. Art can now provide the platform to acquired funds. What prevented this previously? Our contract with Art really preceded any of their real M&A and mop up of funds, and while it covered Q Super because that was a merging of the two funds into one entity, there are other funds where they're bringing on slowly. I think there was an announcement this week of, am I right to say, Qantas? Qantas has been picked up. So this is really just to streamline their legals to make sure that they're not having a breach in any of their contracts when they start to roll their services out to those entities. So that's really what that meant. So Q Super was already covered, but some of their more recent acquisitions or fund joins weren't covered.
There's some more questions from Mark at the top before you move.
Sorry, Mark. I did jump. Strategy around refinancing the convertible notes in October. Yeah, Mark, we're looking at a range of strategies right at the moment. You know, obviously we have option to convert, we have all payout. The notes are roughly 3.3 million. We don't have 3.3 million in the bank, so we won't be paying them out with cash in bank. If you do the maths on that, but we are looking at a range of options. We do want to resolve or have to make a decision one way or another on resolving those notes, and then this probably links into your next question, which is we'll probably pick up on at the same time we need to deal with the notes. That payday super window is closing, which means we won't have the luxury of doing one large fund at a time. At the moment, we're doing Hong Kong and rest. That we're expecting that we will need to parallel process, so work concurrently over a range of funds, potentially over the next, as soon as within this next 12 months. So that being the case, we definitely are looking at our resourcing options, investment options, and how we support that. At this stage, we haven't drawn an immediate decision. We have a couple of options available to us. There's a question: do you expect further reductions in the cost to income? This is really where Karen shines. She keeps me well under control.
Someone's got to do it. Look, I think I alluded to this before, and Trent's just reiterated. We've got a lot to do in the next 12 to 18 months, and whilst we are really steaming ahead on the development and implementation for REST and Hong Kong, that will then move into transaction phase, but we are hoping and expecting that we'll have other large funds in the next 12 months that we're going to be doing a lot of that implementation and development work again. So although we'll see the economies of scale achieved once we move to that transactional phase, we'll still have quite a big resource requirement to get all those funds ready before the payday super reforms. So look, I think we'll probably see a stabilisation of that cost to income ratio, and I'm working closely on the budget this year. And as we move through the year and see what work we will actually be contracted to do, we'll certainly be looking close to make sure that we can kind of maintain that stabilised position into the next year.
Yeah. So a couple of more questions. Okay, so I think this covers a couple. So let me just run through. Good question here. We've achieved a little over 40% top line growth over the last 2 years. Is that a reasonable target for FY25? That type of growth is well and truly reasonable for FY26 and 7, in my view, because right now all of our income has been generated by really return for or a portion of our services investment being paid as we do the pilot, as we do the integration to Aspire. So right now we're not seeing any of the new contribution flows. So if you put into perspective, all of these customers we're dealing with are 1 million or more end users. Your starting point there is around $4.50 to $5 worth of revenue. So once they're fully implemented, so 26, 27, 28, we see the full cycle of that income, and we see the payday super benefit on top of that. But really, FY25, to be really clear, I believe there is it's a healthy challenge for the business, but the way I look at it is roughly, and I'm using broad figures, it costs in effort around about $2 million to implement a fund up front, that work. We get a reimbursement through our contracts of around about, we charge for about $500,000 of that work. We do that intentionally because we charge healthy SaaS related income for the full life thereafter. And our experience is these contracts will roll and roll, 7 to 10 year window. It's not in the benefit to make changes, particularly with the price strategy we've implemented at. But next year, if we have to do multiple funds simultaneously, we're going to need to muscle up to do that delivery. Right now, our teams are pretty effective. They're delivering at ART full time, maintaining and working on our existing systems full time, delivering Hong Kong and delivering the REST pilot, which is a bit of an all hands, because we're not just delivering the REST pilot, we're implementing the first of the full industry fund solution. So it's a team that's pretty stretched. So the reality is, I think I'm of the view, as I believe our board will be, is we should be working very hard while the window is in front of us to bring that revenue forward and not take the risk of working in series, because that just invites competition. And I would say the super funds, as we get closer to 2026, will be more concerned about being ready in time than they will be on price, which does open the door for some of our more expensive competitors, and we just don't intend to open that door. So that, as transparent as I can be, that's our belief in the way the business will play out. Do you have an updated timeline on seeing final outcomes from the REST pilot? Yes, at this stage, the pilot runs through to December. I want to be really clear to talk about, we are piloting the enhanced features. We are actually deploying the full production system. So that means into the new year, we then have a good window for doing the rollout. Probably as time matters with these things, REST is predominantly a retail player, and we are piloting coming right into that pre-Christmas period, which is about as busy a time as you'll ever see for retail organisations. So we're trying to navigate that really carefully to make sure we deliver an exceptional experience and aren't disruptive. So the system will certainly be tested in the wild, but that's the timing to date. Is ART likely to adopt this industry solution that we've developed? We don't know. ART have always had a very different model, and they're very strong about the Beam brand that they've built. We're passionate about that brand. We help them build it. We think for now they will stay, certainly. They've extended our current contract to be in that format, but they have opened the door and are keen to be made aware of the different models. It's going to come down, in my view, to if you license our tech and build everything around it, your total cost of ownership, I believe, will be more expensive than the SaaS offering that we're building for the industry funds, because, again, it is purely technologically driven and it's designed to reduce the amount of headcount that is required. So time will tell, but I'd be guessing on that. Right now, they're happy with that model and it gives us an alternative view in the market. Another question, I'm sorry, you get sick of my voice, I'm firing one for Karen in a second. Just going through the list. MUFG's Aspire admin platform services about 7 million members. Are there other service providers that service the remaining 9 million members in AU? And could Wrkr work with those partners as well? So look, we are, firstly, yes, there are other providers. Some of the biggest providers, obviously, Iris, Wrkr are two. And then there are some that have developed or homegrown or used international solution, which is actually what Art has. So there are definitely some other providers in the market. We are not restricted in our current contract, so we could work with those providers. However, at this point, MUFG is so far ahead because the integrations are done, the testing is done, the integration into the service and support model, and there's a queue of positive work together. So as well as we're now being introduced internationally, certainly as a more strategic partner. So at this stage, we're not actively in pursuit because there's more on our plate than we can deal with, but we're not restricted, is the short answer. There we go. It's a great question. Previously, 5 mil workers or members was the target for us over the medium term. That's really where we believed that put us at a very competitive position. 5 million, 15 to 16 million in the total market. My belief is we want to get as close to half. When you're dealing with half of all of working Australians, it's fairly unassailable. It's very difficult to move us out. It really, in our view, it's a good position to be in. So we've extended where I think MUFG or Link was less certain when we started. We believed we would build a relationship with some of those funds directly. We think the combined relationship actually positions us for that higher number, which is why I'm now talking to the 7. So it's maybe see that as more confidence in the business, and also I think it would be a great strategic position to be in. Bruce, who are your competitors outside the unions? Well, the unions, Bruce, the unions don't really touch with. It might be a typo in the questions. Because the unions sit heavily and have in those underlying industries, obviously, and they're one thing unions are pro on is making sure people are paid correctly and they get their maximum super contribution. So no, we don't have any allegiances and no actual connections, but they're not a competitor to us. The competitors we have, to be very clear, in the contribution side and super, it is Westpac is the gorilla, roughly 60%, 20% or above is Super Choice. And then there is Wrkr sits behind, is underneath Precision, which is the next largest, then Wrkr with Click Super, and SCH Online actually is a large part of that. Really, we start to mop up the SCH Online, and the area we're really working or seeking to pick up is really the Westpac space, because Westpac are the current provider to those industry funds. We're, again, probably, a competitor, by certainly SuperChoice, very active. Westpac are a very steady supporter of those industry funds and will support any decisions they choose to make because they are much broader in their relationship as institutional banks. So from that perspective, I would say we don't see active competition there per se. I hate talking about competitors, but I hope that gives
before you go on to the next question, Trent, there's another question that flows on quite nicely from Tristan. That is, most of MUFG's APRA funds are using QuickSuper, owned by Westpac. Have you seen investment by Westpac in building for payday super?
Perfect. Yeah. So we've not seen investment yet, and the level of conversations we're having would suggest that the funds aren't seeing an answer, so they're moving towards an alternative, so short answer is no. They have removed some features over years, so direct debit payments. They don't provide single touch payroll. They've done a couple of things to kind of hold their position and just service what they do have. So yeah, we're not seeing them active. We bank with them, so it's kind of a net in some ways as an outcome for them. Hopefully that answers. I'm just jumping around. Geez, lots of questions. This is great. I'll work up from the bottom and see where we get to. How have you found working with MUFG as the new owner of Link? Good question, John. I'm really happy. I wouldn't say I've seen any change in them because of MUFG as the owner. What I've seen is a change in their current management team because the indecision of being acquired or not acquired or where they're at is off the table. And so now they're certain about what they're here for, and that is to deliver exceptional service and grow. They're not in survival mode. They are in deliver quality and grow. So we're seeing their activity level internationally is high. UK, Hong Kong, and areas around Hong Kong, they are but very strong in their approach to what they're doing in Australia. For us, we've really enjoyed the last, I would say, 6 months. Not even 3 months. Has been a completely different step change. So it's great. We like to move fast, so they're now moving pretty quickly. Okay, just wanted to ask, are there AI options that may speed up onboarding of your funds in the future? Well, Alex, yeah, we've got some, every tech company's got some pretty good boffins. We've got some people who are pretty excited about the potential of AI when used correctly. Certainly we see some large opportunity. I wouldn't say near future because we just don't have the bandwidth to deliver to it, but there are some obvious areas around not just the onboarding has some moments that are definitely beneficial behind the scenes, but actually correct calculation of your super, understanding of your super entitlements under a range of different scenarios such as redundancy, so on and so on. That there's some really easy low-hanging fruit, and that's areas that we're keeping our eye on right now and doing some, I call it playing, because we just don't have the bandwidth to be doing it full frontal. I'll wait till we have the scale of customers. We have just answered that one. Let's see what else we've got.
We've done that one.
Done that one. Sorry, most. Yeah. Sorry, there's a lot of questions. It's good. Do the accounting solutions such as MYOB, Xero, SAP, and Oracle compete directly with you? Short answer is no. They are required to find a partner and work with a partner. I would put SAP and Oracle in the Workday bracket. So they look to deliver good, compelling solutions for their customers, less price sensitive, more quality and quality of data. So it plays well for us. MYOB and Xero, they do work with a lot of small businesses, which is fairly price sensitive. There is a gateway that nobody ever really talks about, or clearinghouse, which is the ATO, Small Business Clearinghouse. Many of the small accountants use that small business clearinghouse. It's great for quarterly. It tells you what your super is because it uses single touch payroll data. That won't work in the future when we move to specifically when we move to payday super, because you can't pay people and pay your super at the same time and then lodge an STP report and then use that report to tell you what your super should be. So there's some major work to be done. We're watching that space and are very close to what the likely outcomes will be. But suffice to say, because we're working with the large industry funds and they're price sensitive, and the way we've structured our solution is fairly price sensitive, I think we're going to be in a good position to be highly relevant to the smaller business support systems, from accounting, MyOb0, as you mentioned, and also just direct solutions for accountants, which we've had a good little foray into, even with our self-managed super fund ESA product. That is predominantly nearly 60% of that growth is from small accountants who deal with a handful of SMSFs. So hopefully that answers your question. And I think I'm going to come back. I think that might also pick up on another question that came in. SuperChoice appears to get most contributions volume they do from MyOb and Xero, as opposed to Wrkr aiming for the larger corporates. Absolutely. We've been, just to finish that piece out, we've been focusing on the top end right now because we obviously you always get great FOMO, but they also the pattern of what we've delivered to Workday is highly relevant to the rest of the top end. The bottom end of town, these are long-term contracts, and so the contracts don't come up yet. So it's a case for us of we are waiting our time, but certainly SuperChoice hold that space right now. My belief is the pressure will be on them to deliver it at our price point, and at our quality for price. So yeah, watch this space. But yeah, as with the super funds, they lock into lengthy contracts, and change costs probably more than the cost of the solution. So they tend to not want to change until they've really made a key decision, and they'll lock in for a period. So that answers on is there any risk that the 2026 timeline of payday super reforms gets pushed out? Always a risk. We haven't seen historically Treasury make the decision and then ATO deploy, right? And the regulators help enforce. Treasury have made the decision because payday super, the data that we hold now on single touch payroll reporting is really what drives the ATO for all of their fraud related work on payment. It also links into Fair Works consideration on targets, and populates a hell of a lot of the data that we get out of the government on just industry insight. So closing this last circle and doing the super is a great way to remove fraud. If you allow super to be paid a quarter later and someone misses and they push to the next quarter, that's 6 months of super that can disappear when companies then disappear. And that's really something that the government want to avoid. The government do pay out as last resort in many of those scenarios, and it costs them a lot of money. So they're pretty keen to close it. So short answer is we can't always be certain it'll happen on that date. There's motivation for it to happen on that date. What we have seen historically, though, is people push out just a portion, and what they'll do is they'll say, okay, big industry, you have to do it. Small business, we're going to give you another 6 months, or this sector will give you another 12 months. So it might be fragmented, but I think they're on the drug. They want that data, and so that's playing to us.
And we've gone over time, but there's one last question on there, which is so would the 9 billion member Qantas Super acquisition by ART add to Wrkr's licensing revenues? if you want to speak to that one.
Yeah, so if and when they roll it onto the Beam and use the Beam platform to process contributions, we do get our licenses mechanism is based on total users, so it'll play in our favour. It's not a huge portion, so I don't think we'll see a large jump from it. When they eventually bring Q Super in, which is still sitting in legacy contracts, that's when we'll see the largest uptick. So we're still the numbers we're getting today, and the 25% increase is net of delivering Q Super, just as an FYI. So there you go. That was a lot of info. Great questions. That's probably some of the sharpest questions we've had in a while doing these. So clearly, everybody's reading well behind the scenes and are well informed. So I appreciate the questions. Karen and I both appreciate all of your time. And certainly, from our perspective, thank you to our shareholders for both taking the interest, but also being supporters behind our business, as we feel we are. We're doing everything we can to continue to improve the business, but also position it for the greatest potential success for our shareholders, of which myself and Karen are. So along with you. So thank you again for the time. As always, we'll put this up online so you can listen again. If you have any other questions, just jump onto the Investor Hub on our website.